Hey everyone, welcome in to another daily editorial here on the KE Report. I'm chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. Now, Jordan, we can talk at length about day-to-day moves and this volatility day after day for the precious metals as gold, silver, they're bouncing back today. Yesterday was a bit of a reversal day. We can overanalyze day-to-day, hour-to-hour moves, but I think the most important thing is to understand the general trend that these markets, any market, is in the near term and in the longer term. Longer term trend for gold and silver is, it looks like, higher. We've seen breakouts in both of these metals over the past pretty much 2 years. However, the short-term trend for gold especially, and the gold stocks, GDX, GDXJ, it's very much sideways. So my question to you is that a bad thing that gold and gold stocks are just moving sideways right now?
No, it's not a bad thing. It would be a bad thing if they were too strong and they tried to break out of these consolidations too soon, because we had a really good move for 4+ months, and now the market needs to correct as far as price and time. And, it hasn't really corrected that much as far as price. So, and after a day like today, you might start thinking, well, now it's just going to correct in terms of time. We've already seen the worst as far as price. And I mean, that's possible. I'm not certain, but I mean, you talked about it. Long-term trend is up, near-term, short-term trend. We're in a consolidation, some kind of consolidation. And I go back to my 2008, 2009 analog, and because the 4-month rebound we had coming out of that low was very similar to the 4-month rebound we had coming out of the COVID panic low in March. And that analog, that correction that GDX had in 2009, that lasted about 43 days. Now we're only in, I think, day 24 right now. So to me, the correction in terms of time, it has more to go. So I think it's way too soon to expect the market to break up out of this consolidation and run. And I'm talking about the stocks more so than the metals. And looking at the metals, yeah, gold has a nice bounce today, but we have to be careful because gold does have some support around 1920, and I mean it's bounced from that a number of times, and so I mean it's possible that if that gets tested again, that could break lower. We could see gold eventually bottom in the low to mid 1800s, but I mean who knows? And my larger point, Corey, I mean we've talked about it. You have to pick the right companies and then buy and hold, and at the same time trim your big winners. So we don't need to complicate things here and now. The market's in a correction or consolidation. Um, you have to look at your own portfolio and determine if you need to trim a big winner or not. But otherwise, if you like what you have, hold on to it because the primary trend is up, and I still see the market moving much higher after this correction. And, I'm not looking for a 3 or even a 6-month correction here as far as time. We're just talking about basically a 2-month correction if we're looking at the 2009 analog. So I know this might kind of bore people a little bit, but I mean that's how I see the current situation. We're in a, call it a correction, call it a consolidation. It has more to go in terms of time. And if you like what you have, hold it. If something gets too overbought, you could trim it. Otherwise, don't complicate it. That's what you need to do. And at the same time, try and also maybe look for some things that you missed. And, maybe as this consolidation continues and matures, maybe the things that you missed might come down to a better entry point.
So, Jordan, I think this is an important thing to consider here is that as, let's say, GDX, GDXJ are for the most part grinding sideways along with the gold price. Yes, fine. This is quite a boring market right now, but it's been a very entertaining market for 2 years already. My question is, though, when you're looking at individual stocks right now, a lot of these juniors, there are some that have sold off. Some have given up 30, 40% from their highs, while others have more or less moved sideways. Now, there are some of those stocks that have just kept on running higher on the back of good news. But how do you view the difference between some of these juniors where in the face of no news, some have pulled back and others have more or less held their recent gains?
That's a really good question, Corey. And I think it has to do with the quality of assets that these companies have, or at least what the market thinks they have. And the reason is, companies that fundamentally are really top tier as far as juniors, like we're talking about, they tick all the boxes. They have whether they're a producer or an explorer developer. I mean, they tick all the boxes. And then if you look at the project, like their project is strongly economic or potentially strongly economic, those stocks are not going to correct as much as everything else. And to that everything else example, like companies that are not top tier in terms of fundamentals, like those are the ones that are at risk of correcting 30 or 40%. And I mean, some of those had really great moves, and I probably own one or two of those, to be honest. But you have to make a distinction between, okay, this is something that is really top tier all around versus, okay, this is something that it was really undervalued. It had a really great run, but the reason it could correct 30 or 40% is because it's not top tier fundamentally. And then therefore, when the sector cools off like this, the people that are buying when it corrects are, I don't like to use the term like smart money all the time, but I think it's when the sector's correcting, I think it's more the professionals, maybe the smartest retail players. When the sector's correcting, those types of investors, they're buying the top tier companies on weakness. Whereas the other stocks that are at risk of correcting 30 or 40%, they're not being bought by industry investors and the smartest retail people. They're more focused on top tier stuff fundamentally. They're more focused on the companies they think are going to be bought out by the seniors, et cetera. When they're doing really well and they're going up, I mean, that's being pushed up by, in many cases, they could be being pushed up by less sophisticated buyers, Johnny come latelys to the sector, et cetera. And so then when there's a correction, those types of companies that are not the strongest fundamentally, they can correct 30 or 40% because the buyers for those types of companies, when there's a correction, they tend to disappear because they're coming in and buying based on improving sentiment in the sector. They see silver going up, I got to buy a silver stock. But again, when the sector's correcting, consolidating, the momentum comes off, the sentiment also comes off. And so the buyers for those that are not the strongest fundamentally, they also step away. They're not buying. They tend to buy when the sector's hot and things are going up. So I hope that distinction kind of made sense.
Yeah, I think it does, and it really is just about sticking to high-quality assets, high-quality companies, and, well, you might have missed out on some of that run, but if they do pull back a little bit, does enter a good buying opportunity. What about companies, too, that have run up with the market, but also with the anticipation of drill results? There's a lot of drilling that's been going on, especially in the northern hemisphere, as some of these seasonal plays have opened up and companies have been cashed up to get these drill programs ongoing. How do you trade a stock? It might be tough to say individual stocks, but broadly, when you see stocks move so aggressively before drill programs, even initial drill results?
You got to be trimming those before the news comes. I mean, and that's another thing. And I know this is hard to do because this is subjective, but you also have to look at stocks and figure out, or ask yourself, has to go do with selling and I guess trimming. You really have to ask yourself, why did this stock go up? Is this stock just going up because the sector's going up? Is the stock going up because there's a lot of people promoting it and recommending it, but they don't really have the drill results to back it up? I mean, when you see those stocks like that making those huge moves before they've even reported drill results, you have to be trimming those. I mean, it's too risky to, and then you can talk yourself into it in some cases, like, wow, this stock is up 100%. Well, because the market knows, the market thinks, they're going to hit it huge with this drill program. And I mean, that may be the case, but look, we have to try and be smart and execute things correctly. If you own these stocks and they've made huge moves ahead of news and they're reporting drill results, which are a gamble, it could go either way, you have to take some money off the table, book some gains there, take some money off the table. I mean, you're not trying to look, we're trying to maximize our gains over the long term, but when something really pops, makes a huge move, but it's on speculation or just improving sentiment before they even report the drill results, you have to trim that position. I mean, you have to take something off the table. Don't let it all hang just on news. I mean, that's gambling. You have to have a strategy to reduce your risk.
So, Jordan, final comment when it comes to new companies. Look, there's a lot of new companies that have entered the sector. That happens when a market is breaking out and more interest comes in. But how do you view some of these new companies? And I know some people almost feel pressured, like they need to be getting into almost every new issue that comes across their desk.
Well, I think in most cases, Corey, I mean, generally you don't want to force it. Now, if in these types of situations, and again, sometimes it can be hard to value most of these new companies, but that being said, if the value looks like it's really good, that would be the reason you want to get into it right away. And again, that can be hard for most people to determine the value because in many cases it's subjective, but that's something I look for. Like, it's something where I don't want to get into it or buy it right away unless you look at everything and the value is so good and it's just like a ground floor opportunity. Or you look at the market, go, well, they have they have these assets. This is the team running it, and the market cap is really, really low. The value looks really good. This is probably not going to get any cheaper. That would be the case when you want to buy into it, but at the same time, in most cases, you have to be careful because when these things are coming out of the gate, they're in many cases, they've already done financings. And so in 4 months, there's people that can sell. It's being promoted by various newsletters. So a lot of that buying comes in. And that's just stuff you have to be a little careful about. You don't want to jump in with the crowd early on. Unless, again, I go back to the first thing I said, unless the value is just so amazing, which, I mean, that does happen in some cases where the value is so amazing where you have to buy into it because it's not going to get any cheaper ever. I mean, that's rare, but it does happen. But otherwise, there's no rush to get it, especially these things that are, maybe they have a good story, they have some good people, they're being promoted, and then it's like, well, this stock is at $1.50 already. I mean, how many most junior companies? I'm just a little skeptical of those that are really hot out of the gate right away. They haven't done anything, and they're already trading at high levels with respect to the prices that we're looking at as junior investors. Those are the things that you have to be careful of. So don't force it. Let these things get some time behind them. And again, don't force it unless it just looks extremely cheap, like it's never going to be that cheap again. That's usually not the case, but if you're looking at 10 companies, 10 new companies, there's probably one or two that are going to fit that, but the rest you can wait on.
Okay. Jordan, we're going to wrap it up there. Good comments as always, buddy. Great chatting with you every week. If anybody wants Jordan and I to focus on any aspects of, say, the gold, silver, chart, any of those things, feel free to email me, fleck@kereport.com. Jordan, thanks for your time this week, buddy. Chat with you next week.